Hey guys, what's up? Welcome back to another video. In this video, I'm going to be talking about a stock that recently announced earnings for the third quarter of fiscal year 2023, and that stock is Accenture. And we can see that over the last year, Accenture is slightly up, but they're really not as much up as the S&P 500, which is up 11%. So they are underperforming the market over the last year. But in this video, I'm just going to look into some of the recent news that came out surrounding Accenture. This is obviously one of the biggest, most successful consulting companies in the world. They compete with big four accounting firms like Deloitte and PricewaterhouseCoopers. And then I'm also going to look into some of the recent financial statements that came out for their third quarter. And then I'm going to use a discounted cash flow model to figure out the intrinsic value per share for Accenture so we can know if this is a good price to buy into the stock from a value investing perspective. And so right here in this article, it's titled Accenture CEO weighs in on that disappointing forecast. Basically, they recently announced earnings and they said that their forecast for their full fiscal year was going to have to be brought down slightly, mainly as a result, as we'll see right here, of some disappointing news. So why the consulting giant lowered its revenue guidance for the year, the CEO said in their earnings call, "We did take the top end of our range off because what we saw in the last quarter was that small deal projects have come down and were lower than expected. It's something they've been signaling all year, mostly in North America, but it expanded a little bit, and their media and technology industry group also declined more than they expected." As I point out right here, the company did beat both their top line revenue and bottom line net income for the quarter. Analysts were expecting earnings of $3.01 per share or on revenue of $16.4 billion. But for the third quarter, Accenture actually had $3.19 a share and revenue of $16.5 billion. So they outperformed analysts' expectations for the third quarter. Year to date, the stock is up 15% versus 14% for the S&P 500. And also the CEO pointed out that the company has really solid revenue and strong profitability. Year to date, they've had 85 clients who have done $100 million or more bookings for a single quarter, which is 11 more clients than they had the same time last year. And they're really positioned at the moment to catch what they believe to be the next big tech wave, which is artificial intelligence. And this has been a really interesting trend that we've been seeing with a lot of companies that we've been looking at. A lot of companies are really prioritizing integrating AI into their products and services because every company believes that this is going to be a massive wave. They announced earlier this month that they are investing $3 billion into a firm-wide AI initiative. Gen AI is real, which is what the CEO said, and it's transformative. Accenture will look to create solutions and models that help their clients harness Gen AI in a very cost-effective and speedy way. So they're not trying to get left behind as every tech company, every company in the world, not just tech companies actually, but a lot of companies in general are trying to integrate AI into their products and services, and Accenture doesn't want to be left behind in that race. So right here, these are their financial statements. I'm going to look at their balance sheet, income statement, and cash flow statement. This is their balance sheet right here. We can see total assets came out to be $50.1 billion, up from $47.2 billion from the prior period. And then we can see that most of their business is financed by, or actually it's mainly financed down the middle. They have $26 billion of equity, which means they have about $24 billion of liabilities. And we can see that their retained earnings are up from $18.2 billion up to now $18.6 billion. So they do have more cash to reinvest back into the business and then pay out to shareholders through dividends and share repurchases. Right here, this is their income statement. We can see they're comparing their 9 months and their 3 months results. For their 3 months for the third quarter, revenues increased from $16.1 billion to $16.5 billion. So that's an increase of about 3% year over year. And then also if I scroll down here, we can see for net income attributable to Accenture shareholders increased from $1.7 billion to $2 billion. So that's an increase of 13% year over year. So not bad earnings growth and revenue growth for Accenture. And then lastly, right here, this is their cash flow statement on page 10, comparing their results for the third quarter in 2022 to 2023. Operating cash flow increased from $5.7 billion to $6.1 billion. And then we can see in their financing activities, they purchased shares so far for this actually isn't the 3-month result. This is the result for the first 9 months. And we can see for the first 9 months, they've repurchased around $3.3 billion of shares, which is pretty much right on par with the $3.5 billion they repurchased in 2022. And they also paid out around $2.1 billion of dividends, which is up from $1.8 billion year over year. So they have returned more value back to shareholders in 2023 compared to 2022. And of these dividends paid in the first 9 months, this $2.1 billion figure, for this metric, they actually increased their dividend to $1.12 per share, which is up 15% year over year. So they are increasing their dividend payout. And then for their share repurchases of this $3.3 billion, about $789 million of that came in the third quarter. So pretty good. Obviously, revenue is up, earnings are up, and they are contributing more and more to returning value back to shareholders. So right here in this Microsoft Excel, I have a discounted cash flow model to figure out the intrinsic value per share for Accenture. Yahoo Finance is estimating that the company is going to grow at around 8% for the next 5 years. They had around $8.82 billion of free cash flow in their most recent full year. They have $5.4 billion of cash on their balance sheet after subtracting debt, and they have 630 million shares outstanding. That puts their estimated intrinsic value per share at $215 per share, which means that at the current share price, they are not trading below intrinsic value per share. They're trading at $300 right now. So if they grow at around 4 to 8% for the next decade, then that means that at the moment they are not trading below intrinsic value. They would have to grow at a faster rate than that in order to be trading above intrinsic value per share. Right here, I did a competitor and industry analysis comparing Accenture to some of their main competitors, IBM and Genpact. You can see that for gross profit margin, Accenture and Genpact are pretty much neck and neck, but IBM is way ahead of the pack with a 51% gross profit margin. But then if we look at net profit margin and return on assets, Accenture is doing way better than IBM and Genpact. They have an 11% net profit margin and 15% return on assets. With PE ratio, we can see that Accenture and Genpact are pretty much right on par with each other, 18 and 26 times earnings. IBM is at 66 times earnings, so way higher than their other two competitors here. And then for dividend, we can see for dividend yield, Accenture and Genpact are right around the same dividend yield at $1.08 per share for every $100 for Genpact. And then for Accenture, it's $1.35 for every $100 you invest into Accenture. IBM is the highest with $4.68 for every $100 you invest. So from a dividend perspective and from a gross profit margin perspective, it looks like you'd want to give it to IBM. But for net profit margin and also for PE ratio, all in all, you probably want to give it to Accenture. They're doing a little bit better than Genpact in those three metrics combined. Then on the right-hand side here, to end off the video, I wanted to compare Accenture to other companies we've looked at. Right now, Accenture has a share price of around $300 per share and an intrinsic value of $215. So they're trading at around 1.39 times their intrinsic value per share, which is not good enough to beat out Meta's 1.31 times intrinsic value. So far, Google, Alibaba, GE, and Etsy are the only companies we've looked at that are trading below intrinsic value per share, as you can see from this table. Then over here, we can see for growth rate and gross profitability, Accenture had about an 8.64% growth rate, so not good enough to get them onto the table. NVIDIA has the highest at 33%. For gross profitability, we can see Accenture had a 32% gross profit margin and an 11% net profit margin. So for profitability, they're not good enough to get on the gross profit or net profit table. Number one is Adobe with 86% gross profit and Microsoft with 36% net profit. We can see that for the three new tables that I recently added, for a dividend yield, Accenture had a 1.35% dividend yield A little worse than Kroger, but obviously better than Adobe's dividend yield since they don't pay a dividend. And then for Q2 year-over-year revenue growth, the second quarter of the calendar year is actually the third quarter of Accenture's fiscal year, which is why I put that there. But I included them on the table anyway because it's for the same 3 months of the calendar year. But we can see for year-over-year Q2 revenue growth, Accenture had 3% year-over-year revenue growth, worse than Adobe's 9.9%, and then or 9.8%. And then we can see for year-over-year earnings growth, Accenture had 13%, which is better than Adobe's 9.9%, but worse than Kroger's 45% year-over-year net income growth. And then lastly, we can see for stock performance over the last 5 years, Accenture returned over the last 5 years 90.4%. And so that's basically right on par with Adobe, but Adobe is beating them out by 0.2%, so Accenture does not make it onto the table. So far, Tesla has the number one spot with a 1,000% return over the last 5 years. So based on this, it looks like Accenture is not really that competitive compared to the other companies we've looked at. For stock performance, profitability, growth rate, and share price to intrinsic value, they weren't able to make it onto the table to beat out the other companies we've looked at. But for the 3 recent tables that I've added, for year-over-year growth, they're doing pretty good compared to the other companies we looked at. And then for dividend yield, they do pay a dividend, which is same as Kroger, so it's really not much of a comparison so far because Adobe doesn't really pay a dividend. For the industry competitor analysis right here, we can see that Accenture is very competitive. They have strong profit margins, much better than their competitors for net profit and return on assets. They're pretty cheap, trading at a 26 times earnings ratio compared to their competitors 66 and 18. And they do pay a pretty good dividend yield of $1.35 or 1.35%. And then lastly, right here, we can see according to the discounted cash flow model, they are not trading below intrinsic value per share based on these estimates. So not completely sure what to make of Accenture. They're a pretty interesting stock because they were basically a spin-off from a larger conglomerate company or a larger parent company, and they ended up becoming pretty successful and becoming their own company in their own right. So pretty interesting to see where they'll go from here. Let me know in the comment section down below what you guys think of Accenture. Leave a like on this video, subscribe to the channel, and I will see everyone in the next one.